What is an inverted yield curve? You may have seen in the headlines lately that the yield curve is inverted. But what exactly does that mean? We're going to talk about that in today's video. I'm Spencer Ford, CEO and wealth advisor with Conservative Financial Solutions and a certified financial planner professional. Oh no, the yield curve is inverted. It's the end of days. Disaster is coming. If you've been reading any of the headlines in the past couple of months, you've probably seen basically something like that the yield curve is inverted and it's doomsday is upon us. But I want to talk to you a little bit about what the typical yield curve looks like. Then we'll talk about an inverted yield curve and why that gets so much attention. So the typical yield curve looks something like this. The longer that you allow your money to be tied up, the more interest that you can demand, either from a company if you're buying a bond or the government if you're buying a treasury. So if we take treasuries for an example, a three-month T-bill, treasury bill is going to pay you so much interest. A 6-month typically is going to pay you a little bit more. Then you have a 2-year, 10-year, there's all sorts of increments that go along here. But the longer you allow your money to be tied up, the higher the interest rate that you'll be able to demand for allowing your money to be tied up and having that illiquidity issue for that period of time. Now, what I want you to know is that right now, a 3-month T-bill is paying around 5%, and we have what's called an inverted interest or an inverted yield curve. So just to back up for just 1 second, a treasury bill is when you're loaning money to the government as an investment. You give the government some money in exchange for an interest rate that they're going to pay back to you at the end of the term. With a bond, you loan money to a corporation in exchange for interest or a coupon rate. So that's what we're talking about here when we're talking about this fixed interest rate type of asset. And specifically, we're really focusing on T-bills right now, treasury bills. So as I mentioned, we have an inverted yield curve and the three-month treasury bill is paying 5%. And this is what an inverted yield curve looks like. So right now you have a 3-month T-bill, it's paying 5%, and you go more out on duration, and a 2-year T-bill is paying 4.4% as of today, and those fluctuate daily, so you can check them and see if the yield curve is inverted. And a 10-year is paying 3.6 about. So you can see where the longer you allow your money to be tied up for, the less interest you're getting. And that doesn't make a whole lot of sense. Why would that be the case? Why would it be that, hey, the longer I'm allowing my money to be tied up for, I'm getting lower and a lower interest rate? Well, that's because the government doesn't expect interest rates to stay up here for forever. So if they believe, why would they sell someone a 10-year treasury bill that's paying 5% when they believe, hey, maybe in 12, maybe in 18 months from now, we'll be able to sell 10-year treasury bills at 2.5%. So why lock ourselves in for paying 5% for 10 years when, hey, in a few months or in maybe a year or two, we can lock people in at 10 years at 2.5%. And that's really the expectation. The expectation is that interest rates are going to come down over time. So that's why you can get a 3-month paying 5%, a 2-year paying 4.4%, but your 10 years have shorter interest rates that are attributed to them right now. Most likely, if you buy a 3-month T-bill right now, at the end of that 3-year term, I can't predict the future, but my guess would be is that in 3 months, if you go to buy another treasury bill, you're not going to be able to get the same rate as what you got when you purchased the 3-month treasury bill today. The expectation is that rates ultimately are going to start coming down. So, but why does the inverted yield curve get all this press when it starts to happen? Well, because it's predicted every recession that we've had since 1955. So it seems to be a fairly promising indicator. So it's not a stretch to see why it would be the case that, hey, the yield curve inverts, it's predicted every recession since 1955, it gets some headlines. Now, typically when the yield curve inverts, there's normally some not so normal things happening in the economy. And so there's some actions that are being taken to help turn things around. So let's take our current situation. Trillions of dollars have been pumped into the economy over the past several years, and that influx in cash has led to record high inflation. And in order to pull that money out of the economy, the Fed has started raising interest rates. And initially, those interest rates didn't cause the yield curve to invert. But eventually, investors started to realize, and the government started to realize, corporations started to realize and understand that rates weren't going to stay up here for forever. So that's how the yield curve inverted. Just like I mentioned before, why would the government sell you a 5% 10-year treasury when they think in a year or two they're going to be able to buy or sell you a 10-year treasury at 2.5? The expectation is that future rates will be lower. Now, as far as the inverted yield curve predicting a recession, it's kind of a little bit of a chicken and egg scenario. So if without the yield curve inverting, if I told you that housing prices have started to fall, jobless claims have started to tick up, there's been some bank foreclosures, we have record high inflation, would you be surprised if I told you that there was a recession, on the horizon? Nope, probably not. It sounds reasonable. It's almost like the yield curve inverting is the last indicator when predicting a recession is going to come. Typically, when the yield curve inverts, you can expect a recession within the next 6 to 24 months, which brings me to my next point. It's just a predictor. It's a pretty good predictor, but that's all it is. But do I think that there is a recession coming in 2023? Yeah, just watch one of my previous videos. We talked about that. But an inverted yield curve does not predict how deep the recession is. And like I mentioned in the previous video, many economists feel that this recession is going to be fairly mild, somewhere in the vicinity of a 5 to 10, maybe 15% pullback from where we are right now. No one's really predicting that we're going to test the lows that we saw in 2022. But the expectation is that, hey, there is going to be some turbulence ahead. And what I've been encouraging families, and this has to be up to you and your individual situation, but hey, if you're already invested, there's a lot of studies that show staying invested and just going through it and staying the course is your best course of action, because it's hard to know exactly when to get out and when to get back in. But if you have some money on the sidelines that you've been looking to invest, maybe you wait for an opportunity, so you can kind of play both sides there. Leave the money that you have invested, and if you have some money that you've had sitting on the sidelines, maybe you look at your financial decision, or you look at your financial situation and make a decision that you might hold on to that a little bit longer. But what I don't want you to do is I don't want you to allow a short-term inverted yield curve distract you from your long-term goals. It happens from time to time. We go through recessionary periods from time to time, but you can look at the history of the market, and those who are committed for the long term are the ones who reap the rewards. So that is an explanation of what an inverted yield curve is. Thank you for watching this video. Again, I'm Spencer Ford, and we'll see you in the next one.